Okay, this is the problem on cost of capital uh, of a firm, of a multinational corporation. Okay, so we have to answer problems 1 to 3, okay, based on the stock market data given by the following term. Okay, so we can see that here we have Michelle, Russia, and world. So Michelle is the name of the company, and Russia is the country of the company, and the world is the whole world, as you know, our world. Okay, so all the countries. Now you can see that actually this area of the table is showing the correlation coefficient between. You can see that the correlation coefficient between Michelle and Michelle is 1 because these are the same. Okay, and Russia and Michelle is 0.90, and you can see that between Michelle and world it is 0.60, and Russia and world it is 0.75. Actually, why do we need this correlation? We need this correlation to calculate the beta. Okay, so we'll see later why do we need this correlation. Anyway, the standard deviation is also given for these three, for the company, for the country, and for the world market, for the domestic market and for the whole world market. It is 20%, 15%, and 10%. And the return is also given in percentage for the market return and the world market return. The above table provides the correlations. Okay, I have already said that. Okay, and the risk-free return is also given. The risk-free return is 4%. So based on this information, we have to compute the domestic country beta of Michelle as well as its world beta, and also need to explain what these betas measure. Okay, suppose the Mexican stock market is segmented from the rest of the world using the CAPM. So if the market is segmented, okay, then what is the equity cost of capital using the capital asset pricing model? And third, we have to actually calculate the cost of equity again if the market is not segmented, like integrated through say the shares being tradable internationally because they have the Michelle company has cross-listed the shares in New York Stock Exchange. Okay, and after measuring the equity cost of capital in this case, we also have to discuss the possible effect of this integration on the share price and also on the investment decision. Sometimes we forget to what I have seen, the students all just calculate the cost of equity and that's all. They do not explain what have been asked, but you should explain all that has been asked by the question. Okay, so in summary, we have got the expected returns, we have got the standard deviation of returns, and we have got the correlation coefficients between the different pairs of returns. That means between the company and the domestic market, between the company and the world, and between the domestic market and the world market. Okay, so number one, the domestic beta. Okay, we have given a notation for that, beta m for market, and beta this is because this is domestic market, so we have given the letter R for Russia, the first letter of the country name. And also the world beta is given the notation beta m also because this is also considered as a market. Okay, and W for representing the world market of Michelle. So how can we calculate that? We know that the beta is actually equals to covariance between the market and the individual market return and the individual return over the variance of the return. Okay, So we can break this down into this. Okay, this is uh, the standard deviation of the market, market return, standard deviation of the actually not market. This M is for Michel, that means the company return. Okay, the standard deviation of the market return, which is, although we can see R, don't be confused, R is for the domestic market of Russia, R for Russia. Okay, so standard deviation of the market return in Russia, and the correlation coefficient between the company, that means Michel's return, and the market return of Russia. Okay, so this is the relationship between among the correlation coefficient, the standard deviation, and the covariance. Okay, so we can replace this, we can replace the covariance with this part. Okay, sometimes if the covariance is already given, we do not need to think about correlation coefficient, but in this case we have to. Okay, and the variance of the market return of Russia is already given. Okay, actually not given. The standard deviation is given, so very simple, square of the standard deviation. Okay, so if we plug in the values, okay, then we get 1.20 as the beta of the domestic market in Russia. Okay, so now we can also calculate the beta of the world. Okay, that means we can call it world beta. Okay, same procedure, but remember here we have our market is the whole world, so we will have to use covariance between Michel company's return and the world market return, and the variance of the world market return. And we have followed the same procedure. We have broken down the covariance into standard deviations and correlation coefficient. Okay, so same thing, and after that we have found that the world beta is 1.20, which is exactly the same with the previous result. Okay, that means our beta in the beta of the company and beta and of the domestic beta and the world beta, these two are the same for this company. Okay, so both the domestic and world beta turn out to be the same. What is the explanation? Okay, the explanation is, if the market moves by 1%, okay, then Michel's stock return will move by 1.2%. This is the explanation of beta, and we do not need two explanations because we have the same beta for the domestic market and the world market. Okay, so no matter whether the market return of Russia or market return of the world moves by 1%, okay, Michel's stock return will always move by 1.2%. Now requirement 2, as we can see here that the requirement 2 is actually, okay, let us go back and see what is the requirement 2. The requirement 2 is, suppose the Mexican stock market is segmented. Okay, if the Mexican stock market is segmented from the rest of the world, then estimate the equity cost of capital. So we know that the capital asset pricing model is basically like expected return is equals to the risk-free rate times the risk premium. And how do you get the risk premium? We get it by multiplying the beta and the market risk premium. Okay, so here we can see that the risk-free return is already given, 4%. Okay, plus now if the market is segmented, that means in this case we must consider only the domestic market, because the company is in Russia and Russia is segmented from the rest of the world. So in this case the market is actually the market in Russia only, not the whole market. Okay, so we have to take the market return of Russia, which is 11%, minus the risk-free rate 4%, times the domestic beta, that means the domestic market beta, which is 1.20. Okay, so in this case both the domestic market and the world market betas are 1.20. so even if you put the world market beta by mistake, you will get the correct result, but be careful about that. Okay, so now what is the third question? Let us go back and see. The third question is, suppose now that the Michelle has made its shares tradable internationally via cross-listing on New York Stock Exchange. Again, using the CAPM paradigm, estimate the Michelle's equity cost of capital. So this is the first part. At first, we have to estimate the equity cost of capital if the market is integrated by cross-listing and other things. Okay. So now in number 3, actually the calculation is the same like number 2, but only difference is now our market is the world market. Okay, so you can see all these things are the same, only this return and this beta, these two are different. Okay, so why this return is different? Because now our market is the world market, and the return of the world market is 9%, risk-free return 4%, 9% minus 4% times world beta 1.20. Okay, so we get it 10%. So you can see that the cost of equity, expected return on equity is also the cost of equity, we can say. Okay, so the cost of equity is less if the market is internationalized. Okay, so the second part of question 3 is actually you can see that discuss the possible effects. Okay, discuss the possible effects of international pricing of Michelle shares on the share prices and the firm's investment decision. So what are the possible effects? Okay, so we have to discuss we have to discuss two things. One is the effect on the share price and the effect on the investment decision. Okay, so when we have our when we have our market, we have our expected return on equity, then we can say, well, the equity cost of capital is 10% and it is lower than 12.4%, 12.4%, which was the case of segmented Russian market. Okay, so now we can say that, well, the cost of capital has decreased as a result of internationalization. Okay, and if the cost of capital decreases, then we know that the value, the present value of any project will increase, because the cost of capital is used to discount the future cash flows to get the value. So as a result, the firm value will also increase, and we can expect an increase in the share prices. Okay, so what is the effect on the investment decision of Michelle, of this company? Okay, the effect is very straightforward. Okay, if your share price increases, that means if your cost of capital decreases, that means cost of equity decreases, that means your cost of capital also decreases. And if the cost of capital decreases, then you know that normally when you accept the project, the decision criteria is IRR, okay, must be greater than the cost of capital. Okay, so in this case, okay, let's say that K is the cost of capital. Okay, it must be greater than cost of capital. Okay, so if your cost of capital is lower, that means you can expect some projects with even a lower internal rate of return, but still greater than the cost of capital. So in this case, for example, if your cost of capital were based on this cost of equity, higher cost of capital, okay, then maybe you could not accept a project, okay, with a lower IRR. But if your cost of capital decreases, okay, if as a result of the decrease of cost of equity here, okay, then you can accept some more investment projects with even a little bit lower internal rate of return. Therefore, we can say that the Michelle will be able to undertake more investment projects profitably. Okay, so this is how we can solve this problem. That's all. Thank you very much.